$750,000. The standard 4% answer says that portfolio gives you $2,500 a month. A research guardrail strategy can begin closer to $3,250 to $3,500 a month from the same balance. That is $39,000 to $42,000 a year instead of $30,000. The difference is $750 to $1,000 every month. Both numbers are initial gross withdrawals, not guaranteed income and not necessarily what lands in checking. The higher range works only when your plan can respond to market damage, your retirement horizon fits the research, and your tax strategy does not waste the extra withdrawal. So the useful question is not whether 4% or 5.5% sounds safer. It is whether the after-tax amount available in a normal year and the lower amount available after a guardrail cut can both cover the gap your retirement requires. Keep the $750,000 balance fixed for now. 4% produces $30,000 annually. 5.2% produces $39,000. 5.6% produces $42,000. That changes the gross monthly check, but the account sending that check decides how much of it you can spend. If the money comes from a traditional 401k or traditional IRA, the withdrawal is generally ordinary taxable income at the federal level. If it comes from a taxable brokerage account, part of the withdrawal may be your original cost basis, while realized long-term gains can receive preferential tax treatment. A qualified Roth withdrawal can be federally tax-free. 3 withdrawals with the same dollar amount can therefore produce 3 different deposits after tax. State rules, filing status, deductions, other income, and the taxability of Social Security widen the difference. Withholding creates another layer of confusion because withholding is a payment toward your tax bill, not the calculation of the bill itself. That turns withdrawal order from an administrative choice into an income decision. The familiar order is taxable accounts, then tax-deferred accounts, then Roth. It feels conservative because the Roth money keeps growing tax-free and the traditional account remains untouched. It can also create years with very little taxable income, followed by years where required distributions, Social Security, and large traditional account withdrawals arrive together. T. Row Price modeled the consequence. In one household case, filling lower brackets with tax-deferred withdrawals rather than exhausting the taxable account immediately reduced projected federal taxes by $63,000 over the modeled retirement. In a separate case involving a single retiree, early Roth conversions helped reduce the average portion of Social Security exposed to tax from 51% to 33%, while projected lifetime federal taxes fell by $44,000. Those are modeled outcomes, not promises for your return. The useful evidence is that account sequence altered the result by tens of thousands of dollars without requiring a larger starting portfolio or a more aggressive market forecast. The money moved through the tax system differently, so more of it remained available to the retiree. Retirement creates a particularly valuable period for doing this. Employment income stops. Social Security may not have started. Required minimum distributions are still years away. Your taxable income can temporarily fall into a range you may never see again. Taking money from a traditional account during that window can cover spending while filling a lower bracket. A Roth conversion can move additional money out of the traditional account, creating a tax bill now in exchange for fewer taxable distributions later. The right amount depends on your marginal rate today, the rate you expect later, state taxes, health insurance subsidies, and possible Medicare premium consequences. The principle is more durable than any one tax bracket. Use low-income years deliberately instead of automatically protecting every traditional account dollar until the government requires you to withdraw it. Once Social Security and required distributions arrive, your control over taxable income can shrink. I built a digital book called The Exit Code because this exact gap between the 4% trap and a usable retirement income system kept appearing in the data. It connects the withdrawal number to tax timing and a specific exit date, and the link is in the description. After more than 10 years running a business around accountants and tax lawyers, I have developed a healthy irritation with financial numbers presented before tax. A gross withdrawal is not a lifestyle. It is raw material that still has to pass through the tax code. This also means there is no honest, universal net answer for $750,000. Anyone claiming that the portfolio definitely deposits one exact monthly amount without knowing the account mix is manufacturing precision. A retiree with mostly qualified Roth money can keep far more of a $3,400 withdrawal than someone taking the same amount from a traditional account while receiving other taxable income. Your checking account calculation is gross withdrawal, minus estimated federal tax, minus state tax where applicable, minus any income-related costs triggered by that withdrawal. The opening range remains $3,250 to $3,500 gross. Your account sources determine how efficiently you convert that range into spending. By the way, if research-heavy retirement math is useful to you, clicking subscribe helps a lot, so thank you to everyone doing that. Now we can deal with the number that became a psychological ceiling. 4% of $750,000 is $30,000 a year, or $2,500 per month. The arithmetic is flawless. The interpretation is where the trouble begins. William Bengen's original research was published in 1994. He reconstructed historical retirement experiences beginning in 1926, using actual investment returns and inflation rather than asking what happened in an average market. He wanted an initial inflation-adjusted withdrawal that survived every historical retirement start in the test, including the ugliest one. His original result was about 4.15% for a portfolio held in a tax-advantaged account over at least 30 years. The public version became 4% because humans prefer round numbers, and finance loves a rule that fits on a napkin. That number was built to survive an exceptionally hostile historical sequence. It was not the average sustainable withdrawal. It was not a forecast of what a typical retiree should expect. It did not mean every dollar beyond 4% immediately placed the retiree in danger. Think of it as the height of the seawall, designed around the worst storm in the record. A seawall has value. Calling it the normal water level does not. Bengen later broadened the portfolio beyond the original stock and bond structure and identified approximately 4.7% as his revised historical safe maximum. His September 2025 research still described the 4.7% result as surviving after another asset allocation review. On $750,000, 4.7% equals $35,250 annually, or about $2,938 per month. That is roughly $438 more than the standard 4% check before introducing dynamic withdrawals. The static policy has already moved, but the deeper change is psychological. Bengen has explained that the original 4.15% result applied to the extraordinarily unlucky retiree beginning late in 1968. The other historical starts in his expanded database supported more. Roughly 99.5% of the historical retirement starting points allowed a rate above the famous 4% figure. The central historical experience was closer to 6 or 7%, with Bengen's expanded average safe maximum around 7.1%. That is not permission to withdraw 7% from your portfolio and disappear onto a beach. Historical starting dates become identifiable only after their market path has occurred. You do not know whether your retirement begins near the center of the distribution or at the hostile edge. The data remove 4% as a law of nature. They do not remove uncertainty. Once that ceiling disappears, the important decision becomes how your withdrawal changes when reality refuses to follow the plan. Suppose the $750,000 portfolio starts with a 5.5% withdrawal. That is $41,250 annually, or $3,438 monthly. Now imagine 2 years containing the same market returns, a 20% loss and a 25% gain. Those returns cancel each other before withdrawals. When the loss arrives early and the annual withdrawal leaves at the beginning of each year, the portfolio finishes the 2-year illustration at about $657,000. Reverse the order, placing the gain before the loss, and it finishes around $676,000. The market delivered the same 2 returns. Spending was the same. Their order created a difference of nearly $19,000 in 24 months. Extend that interaction across several early years, add inflation adjustments, and the damage can become permanent because the shares sold during the decline are no longer present for the recovery. Average return cannot repair shares that have left the account. This is sequence of returns risk, and it explains why a higher fixed check can fail even when long-term market performance eventually looks respectable. The portfolio needs a rule that reacts before the withdrawal consumes too much of the remaining balance. Jonathan Guyton and William Klinger built one of the best-known versions. Their guardrail system measures the current dollar withdrawal against the portfolio's updated value. If the current withdrawal rate rises more than 20% above the initial rate, the annual withdrawal is cut by 10%. If the current rate falls more than 20% below the initial rate, the withdrawal receives a 10% increase. There are also rules around inflation adjustments and portfolio management, but those two rails contain the core bargain. This is not discretionary panic after watching financial television. The response is chosen before the market moves. You know the income level, the boundary, and the adjustment while your brain is still calm. Use 5.5% as the initial rate. 20% above it is 6.6%. Holding the annual withdrawal at $41,250 for this simplified arithmetic, the portfolio reaches a 6.6% current withdrawal rate when its balance falls to approximately $625,000. Crossing that line activates a 10% cut. The annual amount falls to $37,125. The monthly gross withdrawal falls from about $3,438 to about $3,094. That is the number the higher income claim has to survive. Flexibility cannot mean you plan to spend $3,500 and hope any future reduction becomes someone else's problem. It means your life can function when approximately $344 disappears from the monthly portfolio check. The protection is symmetric. 20% below a 5.5% initial rate is 4.4%. Keeping the original annual withdrawal constant in this arithmetic, the portfolio would need to rise to roughly $937,500 for the current rate to fall to that boundary. The prosperity rule can then raise the annual withdrawal by 10%, taking the monthly amount to about $3,781. That balance is a trigger calculation, not a prediction. The useful point is that discipline works in both directions. You reduce pressure after damage and permit more spending after sufficient growth. Guyton and Klinger's published research tested 40-year retirement periods. Under their assumptions, portfolios containing at least 65% equity supported initial rates around 5.2 to 5.6% at their 99% confidence standard when the decision rules were applied. Portfolios with lower equity exposure supported less. Morningstar's State of Retirement Income Report for 2026 provides a useful modern cross-check. Its guardrail analysis produced a 5.2% initial withdrawal for a portfolio with 40% equities and 60% bonds under its modeled assumptions. Morningstar's earlier guardrail testing reached 5.6% with an 80% equity allocation. That is where the opening range comes from. 5.2% of $750,000 is $39,000 annually, or $3,250 monthly. 5.6% is $42,000 annually, or $3,500 monthly. The studies do not share identical assumptions, portfolios, time periods, or definitions of success. They converge on the mechanism. A flexible policy can support a higher initial withdrawal because the retiree agrees to reduce withdrawals when the current rate becomes dangerous. Retirement length still matters. Morningstar's latest fixed spending analysis estimated a maximum base case starting rate of only 3.3% for a 40-year horizon at a 90% success target. That does not contradict the higher Guyton-Klinger range. One policy tries to protect a stable inflation-adjusted paycheck. The other earns a higher opening amount by making future adjustments part of the contract. The word safe has now changed meaning. Under a rigid policy, safe means starting lower, so spending rarely needs to respond. Under guardrails, safe means starting higher while following predetermined reductions when the account weakens. The safety comes from behavior, not from the opening percentage. And behavior is the expensive part. A 10% cut may sound modest inside a research paper. It feels different when it lands during a bear market, when headlines are unpleasant, travel is already booked, and a roof repair has discovered the same calendar year. I have multiple hundreds of thousands of dollars invested myself, so I do not treat income cuts as decorative spreadsheet features. If your essential bills require the entire high-end withdrawal, you do not possess spending flexibility. You possess a plan that needs favorable returns. Dynamic systems can also leave less money at the end. Morningstar found that fixed real withdrawals tended to produce higher median ending balances because cautious retirees often underspent. Guardrail systems encourage more lifetime consumption, reducing the amount left compounding for heirs or charity. That is not automatically a flaw. Your portfolio has more than one possible job. It can maximize stable spending, increase lifetime spending, preserve a large inheritance, or create a buffer against uncertainty. One policy will not maximize all four. The trade is now visible. The static 4% policy pays $2,500 initially and usually demands less adjustment. The research dynamic range begins between $3,250 and $3,500, while requiring genuine tolerance for lower future withdrawals and potentially lower terminal wealth. The difference matters because it crosses a real household threshold. The latest available Bureau of Labor Statistics age data show households headed by someone 65 or older spending an average of $61,432 annually. That is approximately $5,119 per month. The official estimated average Social Security benefit for a retired worker in 2026 is $2,071 monthly. Subtract that individual benefit from the older household spending benchmark, and the remaining gross gap is roughly $3,048 a month. This is only a broad comparison. The spending figure represents households, while the benefit figure represents an individual retired worker. It does not account for a spouse's benefit, a pension, taxes, or your geography. It should not become your retirement plan. Its value is scale. The 4% withdrawal of $2,500 sits below that approximate gap. The guardrail cut illustration of $3,094 reaches it before tax. The opening dynamic range exceeds it by roughly $200 to $450. A difference that looked like an argument over percentages has become the difference between failing and crossing a broad monthly income benchmark. Your personal result depends on replacing the national averages with your own numbers. Knowing these numbers and building a system around them are two different jobs. I built a digital book called The Exit Code as an analysis of 50 years of retirement data distilled into a mathematical framework for exiting the rat race. For this decision, the relevant parts are the 4% trap, the dynamic withdrawal method that replaces a rigid paycheck, and the Social Security bridge for funding the years before a larger benefit begins. It is 8 chapters of research with no filler, built to convert maybe someday into a date you can test against taxes, market declines, and spending cuts. You can get it for less than a dinner out through the link in the description. The useful connection to $750,000 is that the framework tests normal year income and cut year income separately. That is the test your retirement decision needs next. Begin with essential monthly spending after tax. This is housing, food, utilities, healthcare, insurance, transportation, debt payments, and the minimum lifestyle you are unwilling to abandon. It is not every enjoyable purchase you hope retirement includes. Subtract dependable monthly income. That can include Social Security, pensions, rental income after realistic costs, or other cash flow that does not require selling portfolio assets. The difference is your required net portfolio contribution. If essential spending is $4,700 and dependable income is $2,200, the portfolio must place $2,500 of spendable cash into the plan each month. The standard 4% withdrawal produces that amount gross, so taxes can push it below the requirement. The dynamic illustration begins around $3,438 gross and falls to about $3,094 after a guardrail cut. Whether that supports the $2,500 net gap depends on which accounts fund the withdrawal and what other income appears on the return. Now change the household. Essential spending is $5,600. Dependable income is $2,100. And the required portfolio contribution is $3,500 after tax. Even the high end of the opening range produces $3,500 gross. That household has not crossed the retirement line. The tax bill leaves it short before a bad market arrives. This equation prevents a large balance from creating false confidence. $750,000 can be ample for a household with a $2,400 gap and fragile for one with a $3,600 gap. Portfolio size alone never contained enough information to answer the retirement question. Social Security timing changes the gap. The $2,071 figure is an average retired worker benefit for 2026, not an estimate of your benefit. Your earnings record and claiming age control your amount. For people born in 1943 or later, delaying after full retirement age adds delayed retirement credits of 8% per year until age 70. If your benefit at full retirement age is $2,500 monthly, waiting 1 year increases that applicable amount by roughly $200 per month before future cost of living adjustments. Waiting from 67 to 70 produces roughly $600 more per month than the full retirement age amount. That can permanently reduce what the portfolio needs to supply later. It can also increase withdrawals during the bridge because Social Security is not yet paying. The decision therefore shifts spending between phases of retirement rather than producing free money. Health, expected longevity, marital circumstances, survivor benefits, employment, and available liquidity all matter. Delaying is not automatically superior for every person. The relevant comparison is whether the portfolio can fund the temporary bridge without making the early withdrawal rate dangerous, in exchange for a larger inflation-adjusted income floor later. Those bridge withdrawals can perform two jobs. They can pay living expenses while Social Security is delayed, and they can use low tax brackets that might otherwise go empty. Additional Roth conversions during the same period can reduce the traditional balance exposed to later required distributions. A larger withdrawal before Social Security can therefore look inefficient in isolation while improving the lifetime system. You're drawing more from the portfolio today, but you may be purchasing higher dependable income and greater control over taxable withdrawals in later years. The tax comparison cannot stop at the federal bracket. A conversion can raise modified adjusted gross income and reduce health insurance subsidies before Medicare. Later, higher income can affect Medicare premiums. The correct conversion fills a useful tax window without making another part of the system unexpectedly expensive. Required minimum distributions put an endpoint on part of this flexibility. Current federal rules generally begin them at age 73 for people reaching that age before 2033, while later cohorts move to age 75. For much of this channel's late career audience, 75 is the relevant age, but your birth year determines the answer. Traditional IRAs and most traditional workplace retirement balances are included. Roth IRAs do not require distributions during the original owner's lifetime, and required distributions from designated Roth workplace accounts were eliminated beginning in 2024. Once required distributions begin, the government sets a minimum amount that has to leave eligible accounts each year. You may not need the money for spending, but the taxable income still arrives. Waiting until that point to examine a large traditional balance can eliminate years when smaller voluntary withdrawals or conversions were available at lower rates. The timeline is now one connected system. Retirement creates low-income years. Those years influence account withdrawals and conversions. That tax management affects the later traditional balance. The remaining balance shapes require distributions and Social Security taxation. Those taxes decide what the monthly withdrawal can actually buy. The audience question about taking retirement money monthly, quarterly, or annually has a reassuring answer. Payment frequency does not define the withdrawal strategy. The annual policy defines it. You can calculate an annual withdrawal, decide which accounts should fund it, reserve enough liquid cash for near-term spending, and transfer a paycheck to checking each month. Another household may refill that spending reserve quarterly or during an annual portfolio review. The Internal Revenue Service cares about taxable income and distribution deadlines, not whether your grocery money arrived in 12 installments or 4. Monthly selling can create more transactions and less control over which assets are sold. Taking the entire year's spending at once can leave excess cash idle and can realize income earlier than necessary. A scheduled refill tied to rebalancing and tax estimates often creates a cleaner separation between portfolio management and household spending. The cadence should support the policy rather than replace it. Your annual withdrawal amount, tax source, guardrail status, and required minimum distribution obligations are the decisions. The monthly transfer is delivery. Before declaring $750,000 sufficient, run the bad year test in household language. A 10% withdrawal cut cannot remain an abstract percentage. Identify the spending that disappears if the gross portfolio check drops from $3,438 to $3,094. Maybe travel pauses. A vehicle replacement moves back. Gifts decline. A renovation waits. Those are genuine guardrail options. Prescription medication, property tax, basic groceries, and an unavoidable insurance premium are not. If you cannot name at least $344 of monthly spending that can be removed without damaging the essential plan, then the 5.5% illustration is not your sustainable starting rate. You can still use a dynamic framework, but the opening amount needs to be lower, or the dependable income floor needs to be larger. Your retirement horizon applies another pressure test. Someone leaving work at 55 may need the portfolio to function for 40 years or longer. Someone retiring at 68 with substantial Social Security and a shorter planning horizon faces a different risk. The same $750,000 balance cannot carry one universal rate across both lives. Asset allocation matters for the same reason. The original Guyton Klinger range around 5.2 to 5.6% relied on substantial equity exposure and strict decision rules. A portfolio built mainly for short-term stability should not borrow the withdrawal rate produced by a growth-oriented portfolio and pretend the assumptions followed it home. Fees reduce the amount available as well. A 1% annual advisory fee on $750,000 begins around $7,500 per year. That is $625 per month leaving the portfolio, although the calculation changes with the balance. A high withdrawal rate paired with high ongoing fees asks the account to support 2 retirements. Access rules also matter if you retire before age 59 and a half. Traditional retirement accounts can impose penalties, unless an exception applies. A portfolio can be large enough on paper, while the accessible account mix makes the bridge awkward. Retirement readiness requires enough money in the right places at the right time. Now, the threshold can be stated cleanly. $750,000 may represent a resilient retirement line when the after-tax portfolio gap fits below the guardrail cut amount. The portfolio allocation fits the research, and the household can follow the adjustment rules. If your plan needs every dollar of the $3,500 high end, the higher starting rate has not made retirement safe. It has made the opening year affordable under favorable conditions. Those are not the same result. This is a brain problem as much as a math problem. Your mind treats the opening paycheck as ownership. Once $3,500 appears in checking, reducing it later feels like a loss, even when the reduction was part of the original agreement. Writing the cut-year budget before retirement prevents your future brain from renegotiating the rules after the market declines. The same psychology makes 4% attractive. It feels like an external authority has taken responsibility for the decision. A universal number removes the discomfort of choosing a trade-off. Unfortunately, retirement still sends the tax bill, changes the portfolio balance, and adjusts your spending whether the rule acknowledges those variables or not. A dynamic policy does not predict the market. It admits that prediction is unavailable and defines how you respond. That mild difference in philosophy is worth $750 to $1,000 of additional initial gross income each month in the research range. Additional work and savings can now be translated into a visible benefit. Every extra $100,000 adds about $333 per month at 4%. At 5.2%, it adds about $433. At 5.6%, it adds approximately $467. Under the 5.5% illustration, the increase is about $458 per month. You can scale that down. Every additional $10,000 of portfolio value supports roughly $33 per month at 4%, or about $46 under the 5.5% illustration. That gives another month of work a measurable output once you estimate how much the month adds through contributions, employer matching, and portfolio change. Social Security has its own visible measurement. After full retirement age, take your applicable monthly benefit and multiply it by 8% for each full year of delay through age 70. A $2,500 benefit adds roughly $200 per month for a 1-year delay. That increase is permanent, while the portfolio has to finance the bridge. This is where the clock-in or clock-out model becomes less useful. You do not need to worship a round portfolio, milestone, or treat another year of work as the default. Compare the income gained from additional savings and a larger Social Security benefit with the time surrendered to obtain it. One more year might create several $100s of later monthly capacity. It also costs 1 year that cannot be repurchased. Once your normal year net income and your cut year net income both cover the essential gap, continued work stops being a rescue mission and becomes a purchase. You are buying additional margin with time. By the way, if you want more portfolio thresholds translated into the dollars that can actually reach your account, subscribing helps the channel more than you might think. So thank you. Lazy investing built more fortune than crypto memes. At $750,000, retirement begins when the cut year check covers your gap, not when a calculator gives you a comforting balance. From that point forward, every extra month has a visible price, and every month you reclaim has one too.